All right, this is one of my favorite segments where we get to have a little fun. It's called Don't Say the A Word. I know people at home are like, what's the A word? What are they going to talk about? And you know, when it comes to this, we're talking about annuities.
Yeah.
One of the most maligned investments on the planet. People love them, they hate them, they don't understand them. And John, I'm going to need your help to break it down for the viewers at home and how these things work.
I have to agree, Greg. I hear that myself. And let's just go back to what is an annuity? Well, an annuity in its original form was to provide a lifetime payment for a retiree based upon the investment that they put into it. But they're so different today. Today, annuities are so much more really about these four things right here. We've got so many great elements that a retiree can use to their advantage in retirement.
Well, I know a lot of times people don't realize that they're starting to replace a lot of, people used to use CDs or bonds, but now annuities are jumping in and say, hey, we want some of the fun. We want to talk about conservative investments, and we have some different features compared to those older investments out there.
That's right. And you know, Greg, as a retirement planner, what I want so much for my clients is to live an awesome retirement life, not having to worry about all their money being in the market and being vulnerable. So this first one is huge, principal protection, an investment where we know what goes in there is not going to get wiped out by a market decline. So that's very important. That's one of the elements of an annuity is principal protection.
We should star that one. I think that's probably everyone's favorite part of them.
That is a big one, absolutely. You got a few more on here. Let's go down to, let's actually start with this tax deferred right here. That's a big one. So this concept of not paying taxes every year like a CD would can actually lead to higher values in the investment. If we don't have the tax obligation of the investment coming out every year, well, guess what, Greg? That money just continues to compound forward. You end up with a higher amount over time.
You get to grow your interest on your interest without paying tax on it.
Without paying taxes.
Which I'm guessing leads to you making more money.
That's right. And isn't that what it's about?
Right. Yeah, that is what it's about for sure.
So moving on, annual flexibility, annuities, again, going back to how they used to be with just income payments. Well, today there's so many options in these annuities. We can have a nice hefty fixed rate as our investment option. We can get into the market as an investment option. We can change it up as we go. A lot of flexibility in these annuities today.
And a lot of times people don't realize when you buy a CD, it's like that for 10 years. If you buy a bond, it's like that for 10 years. But with an annuity, every year you can change the investment options.
Yeah, it's a wonderful thing. With our clients, we're meeting with them annually at least, and we are talking about what do we want to do this year in the annuity? What do we think the market's going to do? What's the best thing to do? So we'll look at those options and we'll select the best one.
Awesome.
Yep. Next, let's move on. No ongoing fees. I mean, who wants to pay unnecessary fees in their investment? I don't, right? So the annuity options that are out there today, there's many that have no fees, okay? If we're not doing any kind of special bells and whistles, the client does not have to pay fees in the annuity.
As opposed to a mutual fund that has fees every year, or if you're paying your advisor 1% every year, those fees are coming out of your principal. But with annuities, you kind of buy what you get at the beginning, and that's just what it is.
That's right. We're paying for things that you just mentioned, money going out the door, unnecessarily going out to things we don't need. We want our retirees to keep as much of their money in their investment.
That makes perfect sense.
Yep.
Now, I know one of the big questions we get is, should I buy a CD or should I buy an annuity?
Right.
Maybe help the viewers quickly at home here go through some of the differences between the two options, why you would choose one over the other.
Greg, let's start with access. We're comparing CDs and fixed annuities here. With the CD, there's really no access. You have to wait till the end of that maturity before you can access anything. With a fixed annuity, you have this nice convenience where the money can be accessed along the way, and it really helps retirees out.
How much access do you get a year?
It's usually about 10% a year, which again is a huge convenience for the retiree. Annual flexibility, there's plenty of things to choose from in the fixed annuity world, whereas a CD, again, one-dimensional, really just pretty straightforward.
Yep.
Ongoing fees, no and no. Certainly with this type of fixed annuity, you're not paying a fee. We talked about that, very similar to a CD, so you don't have to worry about that. Fixed rate of interest, with a CD, we know that's what that's all about, but it's also an option with a fixed annuity as well.
So you could have 5% or 6% over the course of the term.
Absolutely, and right now, these rates are being benefited by the high interest rates that we talked about earlier. Participate in the market or interest option. Well, with a CD, it's pretty much a fixed rate. But with a fixed annuity, you can participate in the market, which, again, it's a wonderful option for the retiree.
Fixed index annuities, when you keep hearing those all the time, that's what they're talking about. You can participate in an index.
That's right.
Okay.
That's right. And we'll look at that every year and see what the options are. Preferential tax treatment, we talked about that one. CD every year that the maturity comes due, you're paying taxes on that investment. But with a fixed annuity, you're not paying taxes. That we're deferring those taxes until the money comes out.
Let's touch on that real quick.
Yep.
When it comes to tax deferment on a $250,000 investment over 10 years for a 5% return, if you compare the two with tax deferred, what kind of savings are you going to get from a fixed annuity compared to a CD?
Yeah, so using this example of $250,000 over 10 years, average return of 5%, a CD will accumulate to $366,518, okay? And that's because it's got the resistance of the taxes coming out of it. Unlike that, the tax deferral gives us a higher value. You looked at the fixed annuity there, where taxes are being deferred and the investment is compounding. $407,224, over $40,000 of additional return, Greg.
Almost $50,000 on a $250,000 CD versus annuity investment. That is real money and the power of compounding with annuities. If you want to talk about more than just stock picking investments, like when to take money out of your IRA to beat Uncle Sam, or how to cut your investment costs in half, how to protect your house from long-term care costs without buying expensive long-term care insurance, or how to make sure you aren't taking on too much unnecessary market risk, then get your roadmap for retirement right now. Our roadmap is built by our internal team of attorneys, CPAs, and financial retirement planners to address the 4 largest risks in retirement.